All right, let's dive right in. Today, we're tearing down a professional stock analysis of a really interesting company called Jupiter Wagons. Now, this company is sitting right in the middle of India's massive railway boom. We're going to look at the numbers, we'll weigh the good against the bad, and then we'll get to the analyst's final call. So let's get into it.
First things first, you really need to get the big picture here. To understand a company like Jupiter Wagons, you've got to appreciate the sheer scale of what is happening with India's railways. We're talking about a country in the middle of a colossal, once-in-a-generation overhaul of its entire system. They are pouring unbelievable amounts of money into modernization, building out these huge, dedicated freight corridors. This isn't just some minor upgrade, you know? It's a fundamental change that creates this absolute tidal wave of demand for any company that plays in this space. So, in the middle of this whole railway revolution, who's our main character? Well, that would be Jupiter Wagons Limited, or JWL for short. Let's get a closer look at who they are. To put it simply, JWL is the top dog in India when it comes to making railway wagons. They're the ones building the freight cars, the passenger coaches, all that specialized gear you see running on the tracks. They are, without a doubt, a key player, basically building the very things that move this whole infrastructure ecosystem forward. But here's the thing. JWL is not a one-trick pony. Not at all. Yeah, manufacturing is their core, their bread and butter, but they've built out this really smart, diversified business. They also lease out wagons, which gives them a nice, steady, recurring revenue stream. And on top of that, they offer maintenance and engineering solutions. This mix makes their whole business model so much stronger and way less dependent on just the ups and downs of manufacturing. Okay, so we know who they are, we know what they do. Now for the part every investor, and probably you, really wants to see. The financial health check. Let's put their numbers under the microscope and see what this analysis really dug up. First up, let's talk sales growth. Over the last 5 years, JWL's sales have been growing at an average clip of 28.5% every single year. That is some seriously strong and, more importantly, consistent growth. It's a clear sign that they are absolutely capturing the rising tide of demand in the sector. Now here's where it gets even more impressive. Their profits? They grew even faster than their sales, at over 35% per year. And this is such a crucial point. It means they're not just selling more stuff, they're actually becoming more efficient and more profitable as they get bigger. That's the sign of a really, really healthy operation. And finally, let's look at this metric, return on equity, or ROE. At 18.5%, this number basically tells us how good the company is at using its shareholders' money to make more money. Think of it this way. For every 100 rupees invested, they're generating 18.5 rupees in profit. An ROE like this is considered very strong. It shows they're using their capital incredibly well. Okay, so the financials look pretty solid, right? But every single investment story has a conflict. This tug of war between the good and the potentially bad. So let's break down the bull versus the bear case for JWL. On one side, you have the bulls, the optimists. They're looking at these massive government infrastructure projects and seeing a gigantic long-term growth driver. They point to JWL's leadership position in the market and their incredibly strong order book, which means they know where their money is coming from for years. But on the other side, you have the bears, the skeptics, and they highlight the risks. That heavy reliance on government contracts, that's a big one. They're also exposed to unpredictable raw material costs, like steel prices going wild. And the whole business is cyclical. It rises and falls with government spending and the economy. So, after weighing this strong growth, the healthy financials, and that constant tug of war between all the opportunities and all the risks, what's the final verdict? Where did the analysts land after putting all these pieces of the puzzle together? The conclusion from this entire analysis is clear and direct, a buy recommendation. And the target price they've set is 650 rupees per share. Now, depending on the price when this report was written, that suggests a pretty significant potential upside. But it's really important to know that a target price isn't some magic number set in stone. You see, the analysis actually gives us a range of possible outcomes. That 650 rupee target, that's the base case. It's what's considered the most likely scenario. But if things go a bit wrong, like project delays or cost pressures, you get the more pessimistic bear case, where the valuation is closer to 420. And on the flip side, if everything goes perfectly, you get the optimistic bull case, where it could go as high as 850. It really shows you the whole spectrum of possibilities. So let's boil it all down. The core argument for this buy rating really comes down to these key things.
The analyst sees JWL as a market leader with rock-solid fundamentals. It's perfectly positioned to ride that huge infrastructure wave. And with an order book that gives them a clear view of future revenue, the report suggests it's still trading at an attractive price. So look, the analysis makes it pretty clear that the tracks for growth are all laid out. The path is there. But the big question that lingers is this: can Jupiter Wagons successfully navigate all those risks, the dependency, the costs, the cycles, to keep its journey on schedule? And that right there is the central question for any investor looking at this company.